Hello and welcome to Investment Insight, your clear take on the markets. Let's get started.
It's good to be here because we are looking at an economy that, well, it seems to be pulling itself apart at the seams.
That's a strong way to put it.
Well, look at the headlines, and you see growth, you see strength. But then you look under the hood, and you start to see genuine structural decay. The official numbers are telling one story, a story of prosperity, while the foundational institutions are, well, they're whispering about a crisis.
Exactly. And our mission today is to dive into the data we've investigated to decode this highly unusual, I'd almost call it schizophrenic, global financial landscape. We are facing a core paradox right here at home that is baffling and, frankly, quite dangerous for any investor who isn't prepared.
That paradox is the hook for everything we're going to talk about. How can the U.S. economy boast a strong, a seemingly fantastic GDP growth rate? We're talking 3.9% annualized in the third quarter.
A huge number.
A huge number. But at the very same time, regional banks are failing at the fastest rate we've seen in 15 years. That disconnect isn't some small anomaly. It is the entire story. It tells you exactly where capital is flowing and, critically, where it's drying up.
So we've broken this down into three massive interconnected themes we need to unpack for you. First, we have to tackle that paradox head-on, the strange case of a booming GDP that's masking a profound domestic credit crisis. And we're going to argue this is largely driven by the extreme investment tidal wave fueling AI infrastructure.
Then second, we'll shift our focus to the future of technology and geopolitics. We're looking at a tectonic shift in the semiconductor world. We've confirmed details about Apple moving away from its total exclusivity with TSMC and forging a really powerful alliance with Intel to bring cutting-edge chip manufacturing back onto U.S. soil.
A huge deal. And finally, we will investigate the rise of the bond vigilantes. This is a term you're going to hear a lot more about. These are the powerful, almost shadowy global debt police. Right now, they're focused on attacking the sovereign debt of Japan, but the data suggests they have their eyes firmly set on the massive U.S. budget deficit as their ultimate target.
We're looking at market forces that are restructuring global finance, supply chains, and government stability all at once. So let's begin with that U.S. domestic situation.
Okay, let's unpack this first puzzle piece. We have to start with the paradox that's shaking the foundation of the U.S. financial system. We're calling this the AI paradox. Bank failures and the crowding out effect.
Right. And the reality of regional bank stress is, at this point, undeniable. Based on the most recent data, bank failures are surging. This marks the worst situation the banking sector has faced in 15 years.
15 years. So we're talking about post-2008 crisis levels of stress.
We are. And this isn't just a handful of troubled institutions here and there. This represents a systemic stress that's building in the financial bedrock of the country.
And this is an important distinction we need to make right away. We're not talking about the massive, too-big-to-fail institutions that dominated all the headlines back in 2008.
No, not at all.
This stress is focused squarely on the foundation of local and regional finance. The mid-sized and the small community banks, particularly concentrated in areas across the Midwest and Texas. The banks that lend to local businesses.
And the problem is not hypothetical, it's accelerating. Following a pretty serious spike in October, the analysis shows 3 more regional banks either filed for bankruptcy protection or were just taken over by the FDIC in November alone.
Wow.
And when the FDIC has stepped in that frequently, it sends a profound systemic warning that things are not getting better. They are not normalizing.
So the immediate critical question is, what is the pressure point here? Why are these regional banks specifically the weakest link in the chain right now?
The answer, every time we look at the data, consistently points to their disproportionate exposure to commercial real estate, or CRE. For these regional banks, CRE often represents 50% or more of their entire loan portfolio. That's a much, much higher concentration than you'd find at the large money center banks.
Let's just make sure we are crystal clear on what CRE is for everyone listening. When we talk about CRE, we're referring to office buildings, retail spaces, strip malls, mixed-use developments.
Basically everything that is not a residential house.
Right. And these local banks are so heavily exposed because they're the ones who are the primary lenders to the local developers, the person who built that new office park on the edge of town or that shopping center downtown.
Exactly. And the reason for failure is, well, it's a simple but economically brutal combination.
Yeah.
Very high interest rates, combined with soaring vacancy rates.
A double whammy.
A double whammy. We're talking about office and retail vacancy rates that are exceeding 20% in many key metropolitan areas. And this is based on data analyzed just this November.
20%. 1 in 5 offices just empty.
Empty. And that's excluding the few areas where AI data centers are desperately seeking space, which skews the national average to look a little better than it really is.
Let's use a simple analogy here to really show the domino effect. Imagine you're a developer, you own a massive office tower in, say, Dallas, but 1 out of every 5 offices is empty. You budgeted for that space to be 95% full to cover your debt payments, especially now that rates are so high.
Precisely. You are pulling in significantly less rental income than you projected. So when your high-interest mortgage needs refinancing, or when the loan just comes due, which many of these CRE loans are doing right now this year and next, you simply can't pay.
The money isn't there.
It's not there. So the developer inevitably defaults, and who takes the hit? The local bank that holds the mortgage. And because these regional banks hold so many of these mortgages, a single large developer's failure can trigger a genuine existential threat to the bank itself. This cascading failure is what defines the current stress.
And yet, and this is the paradox, we constantly hear this fantastic headline number, third quarter GDP growth of 3.9% annualized. This is what we're calling the deceptive GDP number, or the 3.9% trap. It gives the illusion of a strong, robust, healthy economy, and it completely masks the underlying stress we just detailed.
This is exactly where investors have to engage in critical data analysis and not just read the headlines. When we peel back that impressive number, recent analysis shows that over 70% of that growth originated from just 2 hyper-concentrated sources.
70% from just 2 places.
Yes. And those 2 sources are, firstly, Big Tech's capital expenditures. Their massive spending on equipment and infrastructure, which is overwhelmingly focused on AI. And secondly, huge amounts of government spending, much of it related to infrastructure and defense.
So the economy isn't enjoying this broad-based health that the number implies.
Not at all. It's experiencing extremely narrow specialized growth. And we see profound cracks starting to appear when we look at private consumption, which is, supposed to be the real engine of the American economy.
Right. While Big Tech is throwing billions of dollars at servers and new infrastructure, the data is showing that the average American consumer, particularly in the middle and lower class, is really struggling just to maintain their current standard of living.
And we have the hard data points to back up that struggle. The national savings rate has plummeted to the low 2% range.
Wow, 2%. That's nothing. That's basically living paycheck to paycheck on a national scale.
It is. Most Americans are not building reserves anymore. They are actively drawing down whatever savings cushion they might have had just to cover basic monthly expenses like gas and groceries.
And compounding this problem, credit card delinquency rates are now at the highest level we've seen since 2010.
So people aren't just spending their savings. They are now failing to pay their debts on time. This is the crucial contrast you need to understand. The corporate tech sector is roaring, but Main Street is tapped out.
So if you were to ask us, why is the U.S. economy showing fantastic growth while community banks are collapsing? The answer from the analysis is clear.
It's that the growth is hyper-concentrated in this big tech and government nexus. To put it bluntly, big tech is thriving, and everyone else, the consumer, the mid-market business, and the banks that serve them, is struggling.
And that concentration, that massive focus of capital, leads us directly to the next concept. We're calling it the AI black hole and the resulting credit crunch, which is defined by this economic mechanism known as crowding out.
Let's clearly define crowding out because it's so important. Imagine the financial market has a finite pool of available lending capital, like a giant lake of water.
Okay.
Now imagine a giant, powerful financial magnet is delivered into the room. That magnet is AI infrastructure. It's the servers, the data centers, the power grids to support them.
And why is it such a powerful magnet?
Because the returns there are perceived as almost guaranteed and astronomical. The demand for AI computing power is insatiable. It means that the money you invest today will very likely generate huge predictable profits tomorrow. Banks love that kind of certainty.
So all the capital, all the water in the lake rushes towards that one magnet.
Precisely. Crowding out happens because capital is so heavily concentrated in that one highly attractive, high-return area, AI data centers and their supporting power infrastructure, that it literally starves non-related sectors of funding. All the available liquidity, all the bank lending, all the venture capital. It's being funneled into this financial black hole, leaving very little left over for traditional businesses.
This directly creates what you called the credit crunch for SMEs, which is small and medium enterprises. And a credit crunch isn't just about high interest rates, is it? It's something more severe.
It's much more severe. It's a sharp and sudden restriction of general bank lending, where banks simply refuse to extend credit at all, almost regardless of the cost.
But why are banks restricting lending to otherwise solid businesses? This connects right back to the regional bank crisis we were just talking about.
It does. The banks are spooked. They are prioritizing their own stability and their own high BIS ratios.
Right, the BIS ratio. Can you just quickly define that?
Of course. It refers to capital adequacy requirements. It's essentially a measure of how much reserve capital, or a safety cushion, a bank must hold relative to its risk-weighted assets. A bank that's full of troubled CRE loans, well, its risk-weighted assets rise and its capital adequacy ratio falls into a danger zone.
So to fix that ratio and stabilize themselves, what can they do?
They really only have two choices. They can try to raise more capital, which is very difficult and expensive to do during a crisis, or they can reduce their risk exposure dramatically. And the easiest way to do that is to just lend less, especially to smaller businesses or really anything that isn't seen as essential AI infrastructure. This forced self-preservation is what creates the crunch.
And the impact on the real world is it's tangible and it's heartbreaking. Manufacturing businesses, retail shops, service companies that are totally unrelated to AI are facing a severe funding shortage. The analysis even uses this chilling term, black dot bankruptcy.
That phrase is terrifying, isn't it? Because it refers to a company failing due to a lack of cash or liquidity despite being profitable on paper.
How does that even happen?
Imagine a small, successful parts manufacturer. They have guaranteed contracts, strong sales, everything looks great. But they need a line of credit to buy raw materials and to pay their employees while they're waiting for their big customers to pay their invoices. That's just normal business.
Yeah, working capital.
Exactly. But if their regional bank suddenly pulls that line of credit because the bank needs to shore up its own BIS ratio, that profitable, healthy business can fail just for a lack of operating cash. The AI magnet has pulled all the necessary working capital away from Main Street and left a complete void.
This extreme market bifurcation, big tech way up, traditional business struggling, it gives us exceptionally clear signposts for where investors should be allocating capital. So let's look at the investment insights we can draw from this ongoing bank crisis.
First and foremost, you have to focus on the large financials. This regional bank crisis is not over, and as these smaller tanks fail, their assets and their deposits don't just vanish into thin air.
No, they have to go somewhere.
They have to go somewhere. They are absorbed by the systemically important financial institutions, the SIFIs.
These are the mega banks. JP Morgan, Bank of America, Wells Fargo. They gain market dominance not just by absorbing these assets on the cheap, but also because during a time of fear, massive amounts of institutional and retail money flee from the small, troubled regional banks and flow directly to the too-big-to-fail institutions, which everyone believes have an implied government guarantee.
So the actionable advice here is very precise. The data suggests you should avoid mid-sized bank ETFs, like KRE, which specifically tracks regional banks. Instead, you should concentrate on those large-cap financial stocks that are structurally guaranteed to gain market share, assets, and deposits from all this turmoil. They are actively consolidating power.
Okay, that makes sense. What's the second insight?
Secondly, we have to double down on what we're calling the AI infrastructure mandate. Investment capital is concentrating here for a reason. It's a necessity, not a luxury. If you want to capture structural growth, you have to follow the money trail.
And we're talking about more than just the big chip companies here.
Oh, much more. We're talking about all the infrastructure required to support this massive AI deployment. Data center REITs, power equipment like transformers, circuit boards, advanced wiring, and critically, the energy sectors.
The energy usage for these AI data centers is just staggering, isn't it?
It's almost unbelievable. The analysis points to sectors like small modular reactors, SMRs, the next generation of nuclear power, and efficient natural gas infrastructure as being in a long-term structural growth phase. This is no longer an optional investment. It's essential infrastructure required just to keep the lights on and the AI computing engine running 24/7.
Yeah.
And finally, we have to talk about the inevitable. Betting on the Fed's eventual hand. The Federal Reserve cannot structurally ignore the shaking foundations of the regional banking system indefinitely, regardless of how strong that headline GDP number looks.
Right. If this credit crunch continues and it threatens to spill over into a full-blown systemic panic, that strong GDP number won't matter one bit. Systemic banking failure forces the Fed's hand.
And the insight is that the Fed will eventually be forced to cut rates, or worse, supply liquidity, potentially restarting quantitative easing, QE, just to stabilize the financial system. The current high interest rates, which are making the CRE crisis so much worse, are simply unsustainable under these stress conditions. They will have to prioritize financial stability over the inflation fight if banks are failing.
Because for an investor, what's the safe harbor here?
The data suggests that U.S. Treasuries, particularly short to intermediate-term bonds, offer a dual defensive play. First, they provide defense against a recession if the credit crunch worsens and economic activity stalls out. But crucially, they will capture significant price gains when, and we believe it is when, not if, the Fed is forced to cut rates. This makes them a critical safe harbor right now.
Okay, one final point on this section. There's an opportunity here for a certain type of investor, isn't there?
Yes, and this is essential for private equity and more sophisticated investors. You have to keep a sharp eye on the distressed asset opportunity. Bankruptcies create bargains. Specialized firms like private equity funds and distressed debt firms, such as Oaktree Capital, are going to profit immensely from this.
So how do they do that? What's the mechanism?
They step in with a lot of cash, with liquidity, and they buy quality assets, high-value real estate that is just temporarily distressed, or high-performing company loans at deeply discounted prices from the failed banks or the bankrupt developers. The bank crisis is creating a massive transfer of wealth from weak banks to sophisticated liquidity providers.
That is a comprehensive breakdown. This paradoxical domestic economy, the clear flow of capital towards AI and the mega banks, it really proves that this technological concentration is creating a real financial instability. Let's now transition to our second major story, which focuses on the strategic foundation of that AI growth, the chips, and a massive geopolitical shift. This is the chip wars, pivot Apple, Intel, and the return of U.S. manufacturing.
This is a tectonic shift that has now moved past speculation and into reality. The latest industry reports confirm that the Apple-Intel alliance is not a dream. It's a technical reality, and it's moving from verification straight into production planning.
Okay, so let's unpack the technical breakthrough here, because this really resolves years of doubt about Intel's capabilities. The biggest hurdle that was just cleared is the successful testing of Intel's cutting-edge 18A process.
The 18A process is Intel's flagship next-generation manufacturing technology. It's essentially equivalent to 1.8 nanometers. The crucial analysis confirms that the initial test wafers for Apple's new M5 chip have successfully passed Apple's extremely stringent standards for both performance and, critically, for power efficiency.
And that is just monumental because it validates Intel's long-struggling manufacturing division. I mean, historically, Intel has promised world-beating chips only to face years of debilitating delays.
They have. So this successful test is the ultimate vote of confidence from the most demanding consumer electronics company on the entire planet.
And this isn't some vague promise for the distant future. The reports are laying out a concrete timeline.
They are. The current roadmap anticipates trial production for the M5 chip beginning in the second half of 2026. That will then lead to mass production starting in the first half of 2027. This alliance is now baked into the strategic plans of two of the biggest tech giants in the world.
It is important to stress, however, that this is a dual sourcing strategy. Apple isn't just going to abandon their long-term partner, TSMC, overnight.
Oh, absolutely not. The data suggests TSMC will retain the highest-end, most crucial, and most technologically demanding chips. Specifically the application processors, the APs, for the flagship iPhone Pro models.
The top of the line?
The absolute top of the line. Intel will take on the high-volume, slightly less cutting-edge components, and that includes chips for the iPads and the massive volume of the MacBook Air lineup. It is a classic business strategy of risk mitigation and achieving volume leverage.
So, why is this happening now? This partnership seems almost inevitable because it represents a perfect alignment of interests. Let's start with Apple's motivation.
Apple's motivation is overwhelmingly driven by one word: geopolitics, specifically geopolitical risk reduction. Their entire multi-trillion-dollar business is built upon a supply chain that relies almost entirely on one single company, TSMC, which is based in Taiwan.
And the concentration of their most critical components in a major geopolitical hotspot, the Taiwan Strait, is just an unacceptable existential risk for a company of Apple's scale.
It is. So moving even half of their production volume to the U.S. significantly lowers that strategic exposure.
And beyond the primary goal of security, they also gain indirect financial advantages, right?
They do. By utilizing Intel's domestic fabrication facilities, their fabs, Apple benefits from the entire framework of the U.S. government's GCH Act, That's the massive package of incentives and subsidies designed to revitalize domestic chip production.
So they're essentially getting a federally subsidized security buffer for their supply chain without having to directly apply for the incentives themselves. That's a huge win.
A huge win. Now, for Intel, this is a matter of survival and validation. Their big push to become a world-class foundry manufacturing chips for other companies, even their competitors, is incredibly expensive and requires a guaranteed anchor customer to make the numbers work.
And landing Apple is a success guarantee. It instantly validates their 18A technology to every other potential client in the world. We're talking Qualcomm, NVIDIA, Amazon Web Services.
It tells them, if Apple, a company known for its perfectionism and incredibly stringent standards, trusts our technology, then you should too. It's an immediate massive lead in credibility for them.
Okay, let's translate this massive strategic shift into actionable investment strategies. This huge deal really demands a portfolio reevaluation in the semiconductor space.
Starting with Intel, ticker INTC. This is the definition of a turnaround story, but it's one that requires patience. The Apple contract is a massive catalyst that guarantees dramatic capacity utilization in their very expensive U.S. fabs. The potential revenue stream is enormous, and it's why the market has reacted so enthusiastically.
But that enthusiasm has to be tempered by history. We have to talk about the elephant in the room. Intel's history of manufacturing execution risk, specifically the critical factor of manufacturing yield.
That is the crucial caveat. Yield is simply the percentage of usable, high-quality chips you successfully get from each silicon wafer. And Intel has a history, particularly with previous generations, of promising aggressive timelines and then failing to meet them because of disastrously low yield.
Meaning they just produce too many expensive duds.
Exactly. So why should investors believe the 2027 timeline this time around?
That's the key question.
We have to monitor the real-time news on their yield issues very, very closely. If Intel hits its intermediate yield targets for this M5 chip in 2025 and 2026, the stock has massive upside potential for a major re-rating. If they miss, the stock will be severely punished. The strategy here is cautious but optimistic, maybe using a dollar-cost averaging approach to manage the volatility of a multi-year turnaround.
Now for TSM, they're the incumbent king, and they are losing some Apple volume. Is this a major crisis for them, or is it just a strategic adjustment?
The insight here is that TSMC remains the resilient king. While losing some volume is never great, their fundamental technological strength is completely intact. They retain the ultra-high-performance chip business, where their advanced technology is still widely considered unmatched, and that's where the highest profit margins are.
In fact, you could almost argue that the slight reduction in their dependence on Apple might actually be a good thing for their broader strategy.
Precisely. It frees up some of their capacity, allowing TSMC to prioritize other fast-growing clients, particularly the giants of the AI chip revolution NVIDIA, AMD, and the internal chip designs of the hyperscalers like Google and Amazon. Any significant dip in TSMC's stock price because of this Apple news should probably be viewed as a buying opportunity, as their core business is structurally essential to the entire AI trend.
And we absolutely need to address the competitor caught right in the middle, Samsung Electronics. The analysis points to them facing what's called the sandwich risk.
That's a perfect encapsulation of their dilemma. The Apple-Intel deal solidifies a powerful duopoly. You have TSMC as the unmatched technological leader for the highest performance, and now you have Intel as the US-centric, subsidized, major volume competitor. Samsung's foundry business is now squeezed between two absolute giants.
So if the world consolidates its advanced manufacturing between Taiwan and the US, where does that leave Samsung? Where do they find their niche?
It's a tough spot. Samsung has to lean very heavily on its existing strength, which is its superiority in memory technology, particularly high bandwidth memory, or HBM, which is absolutely essential for AI accelerators. They need to pivot to offering comprehensive turnkey solutions that integrate memory and logic fabrication seamlessly. That's how they can break out of this competitive squeeze. But their challenge just got exponentially bigger.
Finally, let's look at the broader impact on the U.S. manufacturing ecosystem, because this is about more than just two companies.
No, this deal boosts the entire American semiconductor supply chain. When Intel's massive U.S. factories ramp up production for Apple and for others, the direct beneficiaries are the U.S.-based equipment and materials companies. We're talking about firms like Applied Materials and Lam Research. This reinforces that broader revival of American manufacturing theme, making the whole supply chain less fragile and much more localized.
Okay, so we've covered the financial paradox at home and the geopolitical chess match in chips. Now let's move to our final and equally complex subject: the macroeconomic pressure being exerted by the debt police, the bond vigilantes, and the rising serious threat of fiscal risk.
This is perhaps the most fundamental long-term threat to global financial stability because it deals directly with market confidence in governments themselves. And we need to start by defining who these bond vigilantes are and why they wield such immense power.
Simple explanation first. Bond vigilantes are powerful, organized institutional investors. We're talking massive hedge funds, sovereign wealth funds, pension funds, and major asset managers who monitor government borrowing and spending extremely closely.
They are the market's self-appointed enforcers of fiscal discipline. If a government borrows too much or engages in spending that the vigilantes deem reckless or unsustainable, meaning the government might eventually have to inflate its debt away, they punish them instantly.
And the mechanism for that punishment is brutal and direct. They sell that government's bonds en masse.
That's right. And this mass selling drives bond prices down and, most importantly, drives market interest rates, or yields, up. This forces the government to pay exponentially more interest to borrow money going forward, effectively imposing financial discipline through the markets. They are, quite literally, the global debt police.
And right now, these vigilantes have a very clear target under fire, and that is Japan. Japan has become the subject of what the analysis is calling concentrated fire.
And they have the perfect rationale for this attack. Japan is already carrying a historically unprecedented debt-to-GDP ratio of 260%.
260%.
That number alone suggests a government that is structurally incapable of paying back its debt without massive inflation or some kind of intervention.
And what was it that solidified the attack vector recently?
The government announced a massive 39 trillion yen economic stimulus package in November.
So from the vigilantes' perspective,
They read this as, a nation already drowning in debt is willfully going even further into debt to print and spend money, completely ignoring the clear fiscal constraints. This lack of discipline is the signal for immediate market punishment.
and the market action has been immediate and fierce. Data from the end of November shows that the mass sell-off drove the Japanese 10-year yield past the crucial 1.0% resistance point. And furthermore, the ultra-long 30-year bond broke 2.5%.
And this movement is specifically designed to break free from the Bank of Japan's decades-long policy of controlling rates and maintaining low borrowing costs. The message being sent by the vigilantes is crystal clear. You, the Bank of Japan, must raise rates faster, or you must force your government to stop spending. The market is moving beyond the central bank's control, which is an incredibly destabilizing situation.
Okay, so if Japan is the current target, we have to look across the Pacific. What about the U.S.? I mean, we have our own colossal budget issues, running multi-trillion-dollar deficits annually. The data suggests the U.S. is currently experiencing the calm before the storm.
That's an accurate way to put it. The vigilantes are observing the U.S. They're not actively attacking based on fiscal issues right now. The recent increases we saw in U.S. yields were primarily due to the expectation of higher future inflation following that CPI shock earlier in November. The market is in a tactical wait-and-see mode regarding the long-term U.S. debt trajectory.
But the analysis clearly predicts a D-Day scenario for their return. When is that expected to happen, and what would be the trigger?
The experts we've looked at predict the vigilantes will pivot back to aggressive action in the U.S. bond market in early 2026. This timing is critical because it coincides with the expected release and debate surrounding the first full budget proposals from the Trump administration.
And the trigger for that would be, well, it would be familiar to anyone who has studied market reactions to fiscal policy.
Precisely. It's not about the politics, left or right. It's about the math. The trigger would be a massive tax cut or a sweeping new spending plan, or a combination of both, that shows a blatant disregard to the existing, already soaring U.S. deficit.
And the risk is a coordinated sell-off of U.S. Treasuries that could rapidly push our long-term interest rates well over 5%, creating a severe financial shock. We have a recent historical example of this, don't we?
We do. We only have to look back to the UK gilt crisis in 2023. The UK government announced a relatively small-scale unfunded tax cut plan, the mini-budget. The bond market immediately interpreted this as a reckless disregard for fiscal health, and gilt's UK government bonds were sold off en masse.
And the subsequent spike in UK rates created a systemic threat to their pension funds and ultimately forced the government to completely reverse its policy, a total humiliation.
It was a profound, immediate lesson in market discipline. The U.S. economy is far larger, but the mechanism is exactly the same.
Yeah.
The bond vigilantes have the power to force political concessions by hiking the cost of borrowing so high that the government has no other choice but to listen.
So how do we invest to protect ourselves or even potentially profit from this bond vigilante threat while it's building?
Let's start with the immediate opportunities in the Japanese market. The rising interest rates caused by the vigilantes' attack are actually fantastic news for Japanese commercial banks. They dramatically increase the net interest margin, or INEMA. That's the profitable spread between what banks pay for deposits and what they earn from their loans.
So the vigilantes' punishment of the Japanese government is actually a boon for the country's bankers because they can finally earn better yields on their vast holdings.
That's the key insight. Japanese megabanks such as Mitsubishi UFJ and Mitsui Sumitomo are prime beneficiaries of this vigilante activity. You are essentially betting on the normalization of interest rates. We must, however, advise extreme caution regarding the yen itself. It will be highly volatile because of this ongoing tug-of-war between market pressure and government intervention to try and keep the currency cheap.
Okay, turning back to the U.S., how do we monitor the situation? We need a clear signal that the vigilantes have returned and are acting on fiscal fears, not just inflation fears. The research points to a specific technical signal, the term premium.
Let's define term premium. It is the additional return, or premium, that investors demand to hold a long-term bond, say 10 or 30 years, over a short-term bond, like a 2-year treasury. It is essentially a measure of risk over the long haul: future inflation risk, economic volatility, and crucially, fiscal instability risk.
Why does the timing of the rate increase matter here? Why is it worse if long-term yields rise faster than short-term yields?
Because that specific pattern signals fiscal mistrust. We need to watch for what is called a bear steepening. This is when the long-term bond yield rises abnormally fast relative to the short-term yield. It means the vigilantes are demanding a massive premium for holding long-term U.S. debt because they believe America's future fiscal health is compromised. They fear future tax hikes or massive debt dilution down the road.
So if that signal, the bear steepening, appears, what is the immediate crucial action for the average investor?
Reduce risk exposure immediately. This means selling down technology and growth stocks that are heavily reliant on low interest rates and increasing your holdings in cash, or those short-term debt instruments that are less sensitive to long-term fiscal fears. It's a major risk-off signal when faith in the government's solvency starts to waver.
And finally, this bond vigilante threat speaks to a deeper, more systemic problem known as fiscal dominance. If governments can't pay their debts, they just force the central bank to intervene and print the money. How do you hedge against that kind of system-wide loss of faith in traditional currencies?
This is the critical insurance step in a portfolio. Fiscal dominance means the government relies on the central bank to monetize the debt, literally printing money to cover expenses, because the market, the vigilantes, has stopped lending to them responsibly. This process erodes faith in fiat currency systems, paper money, backed only by a government promise.
So what assets provide insurance against that ultimate sovereign debt collapse scenario?
You need non-debt assets. Gold has served this purpose for millennia, acting as a hedge against inflation and government overreach. And increasingly, Bitcoin is viewed by many as the modern digital equivalent of that insurance. These assets don't rely on the full faith and credit of any single state, making them crucial hedges in an environment of accelerating fiscal stress.
And the final precaution from all of this data, the AI paradox, the chip wars, and the vigilante threat, it seems to be simple. Avoid debt.
Yes. In this environment where the cost of money is being enforced globally by these powerful market forces, you have to avoid companies, sectors, and governments that carry excessive amounts of debt. Leverage becomes an existential liability, not an advantage.
We've covered massive ground today, synthesizing 3 major global shifts that are fundamentally reshaping investor strategy right now.
First, we analyze that domestic economic split, recognizing that the booming GDP is a deceptive number. The AI boom is creating a systemic Main Street credit crunch by concentrating all the capital and forcing regional banks to tighten their lending.
Second, we detailed the strategic pivot in chip manufacturing toward U.S. soil, driven by that Apple-Intel alliance. It's not just about technology, it's about national security and the future of supply chain resilience.
And finally, we discussed the global debt crisis being enforced by these powerful bond investors. They're currently focused on Japan, but they have a clear trajectory toward challenging the massive U.S. budget deficit in the coming years.
The core message for you, our listener, is this. You must look beyond simple glamour numbers like GDP. The real story is the crackling sound coming from the foundations, from the regional banks and the mid-market businesses that are being starved of capital by that AI infrastructure magnet.
Therefore, the strategy summary remains consistent. Fortify your portfolio. The data suggests you should shun weak regional financial stocks and mid-cap stocks that are vulnerable to this credit crunch.
And concentrate capital where the market guarantees structural demand. AI infrastructure, which is a structural necessity now, and the safety of U.S. treasuries, which will eventually be supported by the Federal Reserve when it's forced to intervene to save the banking system from a panic.
And as we close, we want to leave you with one final provocative thought that builds directly on that crowding out effect we discussed. We've established that the AI boom is effectively defunding unrelated industries by pulling away all the available capital. This raises a fundamental question for your own long-term investment strategy. Are you prepared for a future where economic growth is not just unequal, but actively subtractive for any business that isn't directly touching the AI and infrastructure megatrend?
That is something to truly mull over as you review your holdings. Thank you for joining us for this deep dive. We hope this has given you clear, detailed insight into these complex market movements. Don't forget to subscribe and hit that like button.